Today on The Wealth Managers with me, Jaideep Hansraj, CEO Wealth Management at Kotak Mahindra Bank. Jaideep, pleasure having you on the show today. Thank you so much. Glad that you could take time out. What a tough time it is for equity followers like us. How's life been dealing with all the actions?
Oh, it's not been easy at all. I mean, especially the last, I'd say about 2.5 months, with equities behaving the way it has behaved. It's just not been the easiest of times at all.
But you guys have been ahead of the curve, right? Both in August as well as September. It's time to sell into equities. Now are you getting clarity as to where our equity markets headed, or do you think it is still so hazy because there are so many events lined up which are going to dictate how equities are going to pan out domestically, and global markets, I would say, have just about beginning to give us those mini earthquakes, mini shake-offs?
Yes, I think the right one was obviously what one did in third week of August, and then again repeated that in somewhere around third week of September of putting underweight calls on equity. They worked out reasonably well. There are enough debates happening internally that is there any merit in trying to reverse at least one of the underweight calls which one took in the months of August and September. But having said that, there is still a lot of thought which is going internally on the 3 or 4 big events which are supposed to play out over the next 3 to 6 months. And looking at investments that one is not going to be an investor for buy today and sell in the next 30 days, 45 days, 60 days or something like that, then obviously one needs to look at a longer horizon. So the events which one is keeping in mind is the fact that how does the Iran issue play out in the first week of November, because that will obviously have ramifications, repercussions on
oil markets.
The second is the 5 state elections which are scheduled from second week November and results coming out second week December, and of course the mother of all, the general elections scheduled sometime around Q2 of calendar 2019. So keeping all these things in mind, and the fact, the big issue that oil today at somewhere between 75 to 80, which had touched 85 at one point of time, how is that going to pan? The currency not showing any signs of abating, still at 73 half levels. So it's actually a combination of a lot of things. And as you mentioned, the fact that global markets have started coughing and sneezing. So it's not something which is an easy decision to take. I think we took that call at the fact that we were looking at weakening macro in a very big way. It's played out well for all the set of investors who've adhered to that call, and I think we'll still wait and watch and take a call on what to do.
So what are data as well as your gut instinct call telling you about which way equities are headed? Looking at all the parameters, looking at all these events which are about to unfold. I'm not even talking about a return of 2017 because I think that was a dream year. But do you think we'll even get back to where we were perhaps in, say, March when the first shake-off happened after the budget? It's a tough one.
It's a tough one, Ayesha, because today the correction in mid-caps obviously has been far, far sharper than the correction which has happened in large caps.
Always is the case, yeah.
At the same point of time, with US interest rates rising and Indian macro looking weak, you've got reasonably large sums of money which are being pulled out of Indian markets by FIIs. How are they going to look at it is something which only time will tell. How are the domestic mutual fund investors and the other set of people, the HNIs, how are they going to look at the domestic markets? So it's a tough one, but I would tend to think that if I were put a gun on my head for the next 60 to 90 days, I'd say that markets would be volatile and would tend southwards rather than northwards.
So what is the market construct now telling you? You were talking about the fact that politics is going to play a very, very dominant role, and out of the 3 factors, 2 were both state elections as well as general elections. Now the market is very divided on how much of a repercussions both state as well as general elections are going to have. Some people believe that the market is already beginning to factor in this big event, the uncertainty that it brings about, and at max it's It always has been. It is going to continue to be just a two-day affair, and the markets are going to move on and forget about it. Do you really think that this event itself has the potential for a big shake-off and a big direction call for the markets?
So let me put it this way. I think the state elections have lesser
Of an
impact on the equity markets. Central elections much more. But at the same point of time, I'm not one of those believers that should something dramatic happen in the central government or in the general elections, that the markets are going to just go completely belly up, etc., etc. They will have an impact for a few days, or at best maybe a week, couple of weeks, blah blah blah. But at the same point of time, I think the things which have happened in the country are reasonably on the right track. So I don't think there's going to be so much of impact which government comes, but there's going to be uncertainty, there's going to be volatility, and a lot of thoughts.
The usual rigmarole, yeah. You know, you made a very interesting point about the fact that there has been that acute FII selling that we've seen, and just month to date itself, it's a sell-figure of a mammoth $5 billion.
That's right.
I remember 2017, we used to boast about the fact that, you know, every day you don't even have to look at the FII numbers. Do you believe that if the FIIs continue to sell the way they have been, DIIs have that gumption and that kind of fund inflow is going to continue? Will they be able to make up for the FII sell-off, or not quite? Not in the current environment.
Not quite. Having said that, I'm a firm believer in the fact that our nation today is clearly, which wasn't such a large equity investment piece, is getting bigger and bigger.
Sure.
I mean, the SIP numbers, everyone talks about the SIP numbers. The SIP numbers are getting better and better. I would never advise anyone to move out of SIPs and what have you. So I think some portion of whatever is happening on the FI outflows can get taken care of by domestic mutual fund investments, but not sizes of what one has seen in the month of October.
And do you also suspect that if the markets continue to be as volatile and weak as they are already, that SIP inflow as well could get challenged? Because, you know, the retail participant always jumps in the last. They always jump in when the market is in an all-time high.
I've been pleasantly surprised of the numbers which one has seen in the months of, let's say, August, September, October. August, obviously, the markets were good. But September and October, you've seen reasonable downfalls which have happened in the markets. Yet, SIPs haven't seen a very large portions of cancellation and whatnot. So I think from that point of view, I'd want to hazard a guess saying that the investor today is behaving far more maturely than before. But how long is anybody's guess. But I think as of now, you are seeing the investor being stable and not redeeming.
Pulling out. What about other asset classes? I mean, do you think that the investor behavior that one is seeing is also because none of the other asset classes are working? You can't put your money convincingly into gold. You can definitely not do that with Indian real estate. You don't have any other option but to look to equities or fixed income as a larger basket. Financial instruments.
Let me try, apart from equity and fixed income, which are your two standard asset classes. Let's look at 2 or 3 asset classes which have been investor favorites for a very long time. Real estate, where I've always been a firm believer that real estate as an asset class had far more money into it of larger high net worth individuals than any asset class in our country. And I'm seeing that shift dramatically. I've been again a believer in the fact for maybe the last 4 or 5 years that real estate as an asset class is not going to give the kind of returns which it has given in the past. And
But is it worthy of a small exposure at least?
Even if I say that people shouldn't have an exposure to real estate as an asset class, people are not going to listen to me. They're going to
Indian mentality.
They're going to do real estate exactly the way they want to. But fresh assets are not going as much as they used to in the past. At the same point of time, I see commercial real estate, people looking at commercial real estate far more than they were looking in the past, and I think that will continue to happen. But people looking at residential purely from an investment point of view or land from an investment point of view, I think that portion is reducing dramatically.
Why do you think that real estate will continue to lag behind as opposed to any other asset class? I mean, what's the obstacle here?
I think it's going to be pure demand supply, Ayesha, because if one looks at residential and with so many unsold units lying all around and sales not happening at the rate at which they were expected to happen, I think it's a pure demand supply mismatch. There is huge amount of supply. Until that supply is not taken care of, and I'm specifically again talking of residential and land, I think this problem of residential real estate investments will create an issue. At the same point of time, if we believe that the economy is going to grow at 6.5%, 7.5% GDP with inflation of 3.5%, 4%, which means nominal rates of 10, 10.5%, 11%, which means the economy is going to grow. And if economy is going to grow, then demand for commercial real estate is going to be there. So it's a clear-cut one that people will look at commercial real estate from both. One, obviously people who are going to use it will buy it or lease it or whatever. But the others will also look at buying commercial real estate and pure leasing it out for returns.
Jaideep, hold on to that thought. We're going to take a very quick commercial break. We've already spoken about equities as an asset class. Jaideep believes that no, not right now is not the time for real estate investments. But when we come back, we'll talk about what is then the ideal asset allocation and whether or not someone should look at gold as an exposure at all in their portfolio. Still in conversation with Jaideep Hansraj of Kotak Mahindra Bank on the wealth managers. Jaideep, before the break, we spoke about equities, which is still looking hazy. Real estate, according to you, is still a no-no. There's still time to go for that one. What about gold? Because just looking at the way the dollar has panned out in the last 1 year, looking at how risk-averse the entire globe is getting, is that the go-to asset right now?
We've never been a very big follower of or a fan of gold as an asset class. But gold is a completely risk-off trade. At the same point of time, from an Indian investor point of view, gold acts as a perfect hedge for currency because ultimately gold is priced at dollars per ounce. So yes, if we continue being on risk-off mode and from a dollar hedging point of view, I think there's some allocation which I'm seeing people making towards gold, but I don't think that will be a substantially big number from a high net worth point of view.
So when you say some, is it low single digits, beginning double digits, low single? So about 5% allocation.
That's right.
So tell me, at Kotak, what are the client categories, if I have to put it like that, right now? And for each of those categories, what would be the ideal asset allocation looking at the environment right now for all asset classes?
So I'll tell you, basis risk profile of various individuals. Individuals get classified into one of 5 buckets, if I have to may say. They are ranging from secure to conservative to moderate to aggressive to growth. And each of these 5 categories would have different asset allocations. To give you an example, a person who is classified as secure would be more or less zero equity. And a person who's classified...
That's only right now or for all time to come?
For quite some time, right from the time we've started this. So it's been a person who's been zero equity. And the other extreme, which is aggressive, would have as much as maybe 100% equity and have nothing else but equity. And then everything in between. So for instance, a conservative investor would have maybe up to 30% in equities. A moderate investor could have up to 50% in equity. A growth investor could have maybe up to 70% in equity. And that's the way the ranges have been, and the balancing portion has been in fixed income. So that's broadly what the range of people have been. So when we put an underweight call, obviously someone who's supposed to be, let's say, 50% in equity would come down by a particular percentage when one puts an underweight call.
So, when you're talking about the aggressive investor, the guy who's willing to put in 100% in equities, are you seeing a behavioral change there as well in your clients? Are they still willing to put all their eggs in one basket? Or now looking at the market, that view is changing? Do they say, like, you know what, okay, maybe 10% could go into fixed income?
Uh, it's happening to a certain extent, but people who've been 100% equities and have seen 100% equities for the last 5, 6, 7 years have made such serious sums of money that yes, they've seen various trends,
Cycles,
various trends and cycles in the market. Having said that, what is happening is that the fresh money which they would have generated from their businesses or whatever is not going into equities one shot. So that's staying out of equities. When one put the underweight call, maybe some portion of equities did get shaved off, but not too much. But the fresh money which was supposed to go into equities at the time in which the money came in is getting phased out.
And where is that fresh money finding its way? Or are people just keeping the powder dry, keeping the stash ready for when they believe the timing would be right?
That's right. That's right. So it's currently staying in a combination of liquid funds, deposits, and whatever.
What is that new asset or new investment tool where people are willing to experiment? You know, my conversations with other wealth managers, some people are saying it's ESG funds, that's fast catching up as a global trend, coming to India as well, perhaps. There are also alternative investment funds which people are looking at. Is there any new theme that you at Kotak are particularly working on or trying to move clients towards that?
I think long short strategies or absolute return strategies with especially extreme high net worth individuals will start seeing, if it's not already started seeing the light of day. I believe very strongly that long short funds or absolute return funds globally have a very large play around it, and I think that's going to happen in India as well. The other thing which I'm not sure how it's going to pan out, but I see exchange traded funds or ETFs at some point of time gaining popularity with high net worth individuals again, because of the fact that cost structures are low and the fact that for the last year or so you've not had actively managed strategies which have beaten the benchmarks. So I think a combination of these two things, I think we'll see far more allocations happening in the months or years to follow.
So when you say ETFs, would it be a particular asset class? Would it be only Nifty?
Could be a combination. Could be a combination. Too early to say, Ayesha, but I think it could be something related to benchmarks, whether it's Nifty, whether it's Bank X, whether it's whatever. But it's I think some time away, but I think it'll happen. But having said that, on the other thing which I was talking about, which is absolute return strategies or long short funds, etc., you're already seeing a lot of money which has been picked up, and I think it's just the beginning of reasonably serious money going there.
So if you had to construct a fresh portfolio, looking at the market construct right now, for say a conservative guy and for someone who's slightly more risk savvy, what kind of portfolio would you construct?
I'd say let's maybe look at a conservative individual today. Sure. I think the conservative individual would be more like 20-25% in equity, about 5 to 10% in absolute return strategies or long short funds, and the balance being in fixed income, maybe with just about 5% in gold.
No real estate.
No real estate.
Okay. And what about the one who's a little more aggressive?
So let's look at a growth individual and not the aggressive individual. Maybe his original plan would have been about maybe 60-70% in equity. I think today that number would be about 45 to 55% in equity, about 15 to 20% in absolute return strategies, and the balance being in fixed income.
When you say equities, is there a particular lineage that you have towards perhaps only large caps, only smaller mid caps, or is it the balanced category, a mix of both that you're looking at as a house right now? What is the safer way to go if you're looking at parking some fresh money into equities right now?
Today, we are predominantly large cap, predominantly large cap. So it could be as high as 100% being in large cap strategies, but not necessarily the case at all points of time. One keenly tracks how the benchmarks are trading, or how the market is trading to various benchmarks, whether it's the Nifty, whether it's the mid cap index, etc., or the small cap index, etc. So I think it's but today, yes, we more or less 100% large cap.
As a wealth manager today, when you say you track your daily day, what are the key 3 things that you monitor which are going to dictate and form your opinion on either equity or oil or real estate or what have you?
I've kept saying this to not only the wealth managers within Kotak, I'd say this to every client today, that somewhere in your screen or whatever you look at on a daily basis, have oil somewhere there. Because I think the impact of oil on our country, on our economy is going to be so huge that one has to necessarily see how oil prices behave. Oil north of 75, 80 is not good for us. We've kept talking about this for quite some time. You had a great situation for the last 3-4 years where we had extremely strong macro but weak micro. And now you're maybe looking at exactly the reverse, where you're looking at weak macro
and improving micro.
And improving micro. And the biggest reason for weak macro is oil. And till that doesn't look like settling down at some price point or the other, I think it's going to have a big impact on our economy and everything around our economy. And we can't shy away from the fact that high oil prices will lead to issues on CAD, issues on fiscal, everything around. So I think that's the single biggest thing which I would advise every investor, every wealth manager to look at, that how is oil behaving, because ultimately that's going to determine how the macros of our country take place.
What's a comfortable level or range in your mind for oil? And what gets you uncomfortable?
I would have obviously said 50. Oil at 50 is great, but
that's utopian.
But that's utopian now. But at a firm level, we've taken a call saying that oil between 65 and 72 is something which we're very comfortable with. But anything beyond that is something which leads to us being uncomfortable, and we are at those points just now. As we talk, oil is at about 75, 77. So
as a wealth manager, are days getting harder and longer?
Obviously.
Looking at the way the markets are?
Absolutely.
Yeah.
It is. I mean, if one is in front of clients today who've
never called you. I mean, not never called you, call you rarely.
No, not only that. I mean, today being in front of clients who've come into the markets in the last 6 months or 12 months are obviously down significantly large portions of their wealth in equities. And the fact that no one likes losing money, and the fact that they've lost money in the last 6 to 12 months of their investments is not the happiest of situations to be in, but that is a reality. But at the same point of time, this is one country where if you're growing at 6.5, 7.5 GDP and 3.5, 4% inflation, you're looking at nominal 10, 11%, which means if the country is growing at 10, 11%, corporate India should do better than that. And as long as your investments are in those corporates which are growing at north of the 10, 11% number, you should be good.
Is that the pitch you're giving to those clients as the CEO of Kotak Wealth Management? Okay, great speaking with you. Thanks
Thank you so much.
Thanks.
Thank you so much.